Hey everyone, welcome to High School Dropouts Advice. Today I will explain why the stock market seems to crash and why it's so volatile the last 2 weeks. To understand why a rising yield affects stock prices, I have to explain the relationship between the yield of the 10 years Treasury and the stock market. After that, I will also tell you what we can expect from the stock market. At the time of recording, we have a yield of 1.57%, which forced many stocks to go down. The rise of the 10 years Treasury yield is because the bonds are selling for cheaper. The bonds are selling cheaper because of the fear of inflation. Let me explain this part. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or the government. When the government is printing money, inflation will happen. The bonds fixed income become less valuable and people are willing to pay less for the treasury bond. So you might ask me, why does falling bond price affect the yield? Let me explain this part. For example, you buy a bond for $100 and 1% is your fixed rate you get on it. Then you will always get $1 per year. Now the government is printing so much money that it will exceed the 1% in return. And they print so much that your $100 loses its buying power. Then you might think to sell it for $90 on the secondary market. The person who buys the bond for $90 will still get $1 each year because the original price was $100. So the second person makes $1 for $90 spent. This is 1.11% in yield. So the yield increases when the bonds are falling in prices. So inflation plays a big part in making the treasury bonds looking bad to invest in them. The Federal Reserve Bank knows that the bonds are not attractive and are buying them until we are back to a 2% unemployment rate. But many people want them to buy more so the yield can stay low. There had been some disappointment when the Fed announced that they will not buy more than they are doing now. If the Fed is not purchasing the bonds have to be sold even lower, which will push the yield higher. So now you understand the relationship between the treasury bonds and the treasury yield. But before we end this part, let me add that the falling bond prices can also be the expectations that the economy recovers quicker, so people are not investing in the treasury bonds anymore. You might ask me if this is not a good thing when the economy recovers faster. Let me explain this. When many people are vaccinated and shops are reopened and the stimulus is given to the people, we for sure can expect a better economy. But the downside is that inflation will happen when the money is in circulation. Let me further explain. When you print a lot of money and give it to many people, but they have no way to spend it, there's no inflation. You will not notice the inflation, but when you open all the shops and lift all the restrictions, you will have all those extra cash in the economy, which will inflate the prices. So when inflation happens, the yield gets higher. Let me explain to you now how a higher yield will affect different companies, stocks, and investors in different ways. When the yield gets higher, then mortgage rates are increasing, slowing down real estate related business growth. Houses become less affordable, builders build fewer homes, people buy fewer homes, less material is spent, and the economy slows down. But a higher yield also means money becomes more expensive. So loans for companies will be more expensive, which means that they cannot leverage as high anymore and have to cut down on expenses, which slows them down in growth, in generating revenue and profit. For investors, a high yield means I can take out my money out of the tech stocks, which has a high evaluation anyway and put them into safer investment opportunities like the bonds. First, the EV and the tech industry were overvalued. People were spending too much money for a future's $1 profit. Why should an investor pay $100 for the company's $1 profit when he can buy a bond paying him $1.50 on the same $100? So what we see in the stock market and the rising treasury yield is a reassessment of the investor's portfolio. Some people are selling their bonds because of fear of inflation, which results in higher yields. So people are selling their stocks and buy cheap and safer bonds. So in the long run, this will find its balance. You can imagine this like a scale, and one part was like pushed too hard and now the scale needs to find its balance again. So when you understand this, there shouldn't be too much worry. The market is quite good at regulating itself. On the other hand, the companies loses their high evaluation because money will become more expensive. But on the other hand, there is more money in circulation, which should help balance it out as well. We need to understand that the Fed is trying to play an active role in this ecosystem. By printing so much money, it will produce a shockwave which goes through the system, so that we will see some sell off here, some buys there, then we will have some spending over there. Many buttons are getting pressed at the same time, so we need time to see how the play works out. As I mentioned earlier, this is like a scale, and the Fed was printing money and put it on one side of the scale. This has to be redistributed to make the scale in balance. Now that we understand that the market will find its balance, do we need to worry about a recession? This is a trickier question. If the yield goes higher and higher, there will be more movement needed in the economy. The stock market and the economy try to reflect the prices based on the yield. If the yield is not stabilized and it goes higher, then we can see a turbulent time. The yield is still very, very low. You can see that at this time of recording, the yield is below 1.6, and historically we have a very low yield. The problem here is not the amount of the yield, but the speed at which it shoot up. It's like a spring that got pushed too hard, and now when we release it, it jumps like really high. We don't know how high it goes, and this is what worries people. Another problem we are facing is that the treasury bonds also lost interest on international level. Big purchaser of the treasury bonds was China and Japan. If they decide to invest less in the US economy and invest in their own economy, then the treasury yield will rise, as you can see here. So in my opinion, we need to let the yield shoot up as high as it goes, because at the moment the yield tries to find the balance, and the economy too. We need to let the economy time to absorb the inflation, the new money in circulation, and investor hopes and worries. It's like a giant stone falling in quiet water in a lake. You need to wait for everything to calm down before reassessing what to do. I honestly think that the stock market overreacted. The yield is still very low. If the Fed wants to have an inflation rate of over 2%, getting a 1.57 yield is still losing money. So I think all those paper hand traders panic sold and created more movement in the stock market than necessary. I think it will not take long and stronger investors are back in the game, while paper hand investors are still selling. Retail investors or weak investors who bought in late and are weak in holding mentality are the ones who will lose money in sell-off like this. I think that 1% yield or 2% yield will not be a big difference when the Fed looks for over 2% in inflation. A yield of around 3% will be more of a game changer. Many people think that the Fed cares about the stock prices and needs to make changes once the stock prices false. This is wrong. The Fed doesn't care about the stock prices. They cannot control how the masses are moving and thinking. They just know that the yield will and should go up by a little, reflecting that their inflation is coming, which was planned and anticipated by the Fed. They could say, this is precisely how we want it to happen, but sorry, I'm not responsible when you guys sold your stock and started the sell-off. This is pretty much what this Fed said today and yesterday in simplified terms. Of course, we can keep printing money, but at one point we still need to slow down for the economy to absorb those changes. This is what the Fed is doing now. On the other hand, I understand that many people need extra cash to survive, but pumping too much money will also create turbulence in the economy. So pumping the right amount is a difficult task. So I'm happy that I'm not a politician. I don't need to think about the right amount. I'm a long-term investor. For me, this market doesn't change my investment strategy. I just keep investing. I'm here to build long-term wealth with my portfolio, and I'm not here to make quick cash. As a long-term investor, I don't need to worry about the last 2 weeks or having sleepless nights. We all know that stocks will go up over time. So I know buying today is better than buying in 10 years. But I don't know if buying next week, next month, or next year is better. But I know for sure in 10 years today's buy was good. Always remember, you cannot time the market, but you can control time in the market. So I encourage you to focus more on wealth and long-term investment than on short-term cash gains. Anyways, for legal reason, I have to say I'm not a financial advisor, so remember, your money is your responsibility. I'm just a guy on YouTube and take my advices as entertainment value only. Do your own due diligence and try to make the wisest move so you and your future generation have it a little easier. Don't forget to share, like and subscribe. Many thanks. See you hopefully in the next video. Thank you. Bye.